Hello and welcome to Sovereign Financials, financial education for everyone.
Alright guys, welcome back to Sovereign Financials. So today we're going to go over part 2 on how to invest in stocks called the price to book ratio. And if you haven't already watched the price to earnings ratio, I highly recommend you watch that first. So the price to book ratio is basically looking at when we buy a stock, how much of the net worth are we buying of a company? Like what is a company worth in just terms of its goods compared to how much we're paying per share? So the first part of a price to book ratio is the price of the stock. That's very easy to get. You can get that on Market Watch, Yahoo Finance, or anything else you like. Now the book value, we can calculate that ourselves by looking at their balance sheet, or we can also use the website which will show us what their book value is, which kind of makes it nice. But a book value basically looks at what is the total net worth of all of their assets, and that can include the buildings the company owns, if they own planes, their equipment, their manufacturing supplies. All of that stuff goes into calculating the book value. Okay, so like we said, determining the price of a stock is very easy, but determining the book value is a little more complicated. So book value is equal to the assets of the company, which again is all of their equipment, planes, manufacturing supplies, buildings, etc., minus their liabilities, which is the total amount of debt they have. So if you take your assets and minus your liabilities, essentially for other people, that would be like your net worth, right? That's your net worth. So if you took all the assets the company owns, you sold them, and then you paid off all of their debt, how much money is left over? And that's what book value is. Now, it is important to remember that book value does not include intangible assets. So it doesn't include things that are difficult to put a price on, such as a patent or intellectual property like trade names, trademarks, or copyrights, because you can't really put a dollar price on those. But it's all their other physical assets that you could easily put up for sale in a market. Okay, so the PB ratio, or the price to book ratio, is equal to the price per share of stock divided by the book value per share of stock. The book value, as we mentioned before, is the total amount of assets minus the liabilities, and then you would divide that by the total number of shares the company has in order to get the book value per share. Now, that's one way of doing it, but most websites will end up showing you the book value per share in a much easier way, as well as the entire PB ratio, which we'll go over some examples here in a couple moments. Okay, so before we go over some real-world examples of PB ratios, let's go over some examples on paper and explain what the price-to-book ratio means. So for first, if you have a price-to-book ratio less than 1, that means that stock is undervalued. So the only way you get less than 1 is if the price of the share is less than the book value of the share. So if the price of the share is $10 and it has a book value of $20 per share, that means I am buying $20 worth of a company of goods, like totally forgetting about the fact that it makes money, etc. I am just buying its assets, $20 worth of net assets for $10. And that's what people, when they say like, oh, I'm buying this stock for pennies on the dollar, that's kind of what that means. If you have a PB ratio of, let's say, 0.5, which would be our situation where you have the price is $10, divided by $20 book share would get you a PB ratio of 0.5. That means you're buying $1 worth of net assets for just 50 cents. So you're buying that share for 50 cents on the dollar. Now, this is a very unique situation because this isn't talked about very often, but this is actually how Warren Buffett made a lot of money. He would come into a company and he would buy them for, pennies, quote, quote, on the dollar, where the price to book ratio was less than 1. He would buy the majority of the company and then kind of take over their board of directors and say, hey guys, look, let's take some of the stuff, let's sell it off and return the capital to investors. Right now, we don't have enough money to be able to buy the majority stake in a company and say, hey, look, I bought $20 worth of book value for $10. Well, let's just sell your entire business and give me the $20. That would be an instant return like that, right? That would be nice, but we don't have that kind of power. But with that being said, anytime you can buy a business that is profitable, which if you go back to our PE ratio, looks at profitability and how much you're paying for it. If you're buying a profitable business and you're buying that business for less than just its assets are worth, that's usually a very good deal, okay? Now, in example number 2, if you have a price to book ratio less than 3, that's usually the fair area, because you shouldn't be able to buy a business just for the equipment it has, right? Because that equipment is put to use and makes profits, so the business price is usually more than just their book value. If I own a company, and let's say my company makes $1 million a year, and all I have is one computer worth $1,000, my company is definitely worth more than just $1,000 my computer's worth, right? Because I'm making millions of dollars a year. So your typical fair value price to book ratio is less than 3. Now here, I'm going to say that a price to book value greater than 3 is overvalued. And really, like, if you're a price to book ratio over 5, that is really the overvalued area. But 3 to 5 is kind of this middle ground. But let's just say a price to book ratio over 3 is a little bit overvalued. Now, I do want to point out that there's a lot of exceptions with these rules, right? If you're a company that is manufacturing goods, then this price to book value should be, these ratios I'm giving you here should be pretty accurate, right? Because you have, equipment and everything that's creating like a shoe, right? You need, certain machines and fabrics and all this other stuff to create the shoe. But if you are a service business, right, then you typically don't actually have that many assets, but you can possibly make a lot of money. So if you're mainly a service business, I don't like looking at price to book ratios too often. And that would be an example, like let's say Uber, right? Uber is a rideshare app, and yeah, they got to have a couple servers, but they don't have to have a whole lot of assets. They don't need a bunch of machinery to make their things work. So with like Uber, you wouldn't necessarily need to have, you would probably have a higher price to book ratio than what you would expect. And it's probably more important to look at earnings and growth and whatnot. All right, let's take a look at some examples here in just a moment. All right, so let's go ahead and go over some real-world examples of price-to-book ratios. Now, if you watched my previous episode where I talked about PE ratio, we'll kind of go over that a little bit here too. I know a lot of you guys use MarketWatch, so we'll start with MarketWatch. And if you look here on the front page, we're looking here at Apple. I just click on this little thing up here, type in Apple, which is AAPL, pulls up Apple stock. Right, so here's their price, and then if we're looking for the PE ratio, that's nice and easy. It's right here on the front. PE ratio is 21. As you guys know, I've said this before, I think PE ratios over 20 are too expensive, and especially as we're going into a recession right now, probably, I would not be buying some with a PE ratio of 21. Okay, but if you want to see the price to book ratio, if you notice, that is not listed here on their main page, okay? But on this little tab here, you click on Profile, and it pulls this up, and then I'm going to zoom in here a little bit for you guys so you can see a little bit better. But under the evaluation tab, it has everything listed. So if you look here, it actually gives you the price to book ratio. Nice and easy. So it makes it really easy for us to find. Price to book ratio is 10. 10, right? That's pretty high. That's definitely higher than 5. So they have a PE ratio of 22, and they have a price to book ratio of 10. Both of those things are bad, and I would not be buying off of either of those ratios. So personally, for me, I am not currently a buyer of Apple. All right, now let's go to another company here. So we have Intel Corp, and if you look on their front here, they have a PE ratio of 12. I do like a PE ratio of 12, actually. I'm a fan of that. Click on the Profile tab. Let's see what their price to book ratio is, and they have a price to book ratio of 3.3. Now remember, I said that if they have a price to book ratio less than 1 is going to be very rare. Okay, guys, that means either something's going crazy on with that company, and for some reason you're able to buy them cheaper than just their net assets. But usually a PE ratio of 3 or less is fairly priced, and then 3 to 5 is a little bit of a gray zone. I'm not too excited about that, and then over 5 is absolutely, in my opinion, overvalued. So they have a a price to book ratio of 3.3. So I'm okay with that. I'm not terribly concerned, and they have an excellent price to earnings ratio of just 12 right now. And this is their current earnings, so if their earnings go down, this will get hurt a little bit. But at a PE ratio of 12 and a price to book ratio of just over 3, I'm okay with that, and actually I am currently buying Intel Corp. All right, so full disclosure, guys, I am buying some of these companies myself. AirCap Holdings is another company. So what they do is they own airplanes, and they rent it out to airliners like Delta or United, whatever. And I don't know the specifics, but they rent out their airplanes to multiple people. So are they going to be hurting right now? Heck yeah, right? Because nobody's going to be renting new planes from them. And I don't know what their contracts look like. I don't know if they say, hey, it doesn't matter what happens to the market, you got to keep the plane for a year. Well, then maybe they'll end up doing okay. But if these airline companies are able to send the airplane back anytime they want, well, then maybe they're going to do really bad. But let's take a look at some evaluations. So they have a PE ratio of 3. Wow. right? That's dirt cheap. Compared to how much money they're making, they make $8 per share right now. Now, this number is probably going to go down because airplanes are not flying right now, and they only have a price of 25, so a little over 3 for their PE ratio. That's pretty good. I'm pretty happy about that. Now, let's look at their price to book ratio. And I brought this up specifically because, look, their price to book ratio is 0.87. So if I just took all of their airplanes and I sold all their assets, which I'm sure includes majority of airplanes, a majority of their assets is airplanes. I sold them all off. I paid off all of their debt. Right, their share is worth the price per share is worth more than $25. So I am buying $1 of net assets for 87 cents here. I'm extremely happy about that. And then they have a PE ratio of only 3. So the question here, and the reason why, so this company is obviously like greatly oversold, right? People think this company is just going to hell. Excuse my language. But the question is like, will they recover? And if they don't default on their debt, they don't go bankrupt, and they recover, that means that you would have bought this stock at extremely cheap valuations. So I don't have any air cap yet. I probably personally will end up buying a small position in this because it's really hard for me to not find something that I could buy for 87 cents on the dollar and not buy it. And this is a company that usually makes money, and they used to pay a dividend. I'm sure that's on hold right now. If I remember correctly, they used to pay a dividend. Let's take a look here. Yeah, so they don't have any yield now. I think they used to have a dividend. I'm not 100% on that. But either way, though, on a valuation basis, AirCap would be really cheap. The question is will they survive the coming recession or not? All right, now let's go over a couple other websites. Some people use Yahoo Finance. If you look here on the front, they do have the PE ratios listed. We can zoom in on this a little bit here. Just give me 1 second. So their PE ratio is, a little too much. So their PE ratio is listed. This is for Target. We're looking at Target here. And their PE ratio is like 16, right? And this number, so remember, if their earnings go down, but the price of their stock doesn't, so the price to earnings ratio would go up. So if Target starts making less money as less people are shopping, the PE ratio is going to get a little bit worse. But right now, at 16, that's not too bad. I like the fact they pay a dividend. I know we're not talking about dividends now, but I do like that. So on Yahoo Finance, though, you'll notice there's no price to book ratio on the front page. For them, you have to click on statistics on Yahoo Finance, and they give you everything here. So the current PE is, they're saying right now, trailing, like looking backwards, is 15.6. They think that based on, and this is just an estimate, so 4 PE is like where do analysts think that their PE will be, in a quarter or so. And that's at 14.29. So they think that it's actually going to get a little better, which means, I don't know, it could mean that their earnings are going to go up, their stocks are going to go down, their price is going to go down, etc. But price to book ratio here, 4.16, right? So is that less than 1? No, so it's not like crazy, oh my god, I can't believe this, which is fine. That's how most it's going to be. Is it less than 3, which we consider fair? No, it's 4. So it's a little higher, but it's not over 5. So I'm not too crazy about this. I personally think that Target might get cheaper than we're at right now. I mean, we're going into a recession. People won't be shopping as much. They currently have a PE of 15, which is, fairly priced. But their price to book's a little high. We'll see what happens, but I wouldn't be crazy about this. But this would not necessarily be a bad deal. It's not like the price to book's over 5 and the PE's over 20, so it just kind of depends. But here's some of the things that we look at. Is obviously, investing is obviously much more complicated than this. You have to look at much more things, which we'll be creating videos for little by little. But these are some ideas on how to assess their value. All right, so another option here is looking at Morningstar, which is another company that people use. Morningstar has a lot of their stuff right on the front page, which kind of makes this nice. So if you see here, they have the forward PE listed on the front of their page, which is 8.7. Okay, this is for Hanes brands, so they make like shirts and clothes and stuff. Kind of like a staple, right? Like if we go into a recession, are people still going to buy their white tees? Yes, in my opinion, they will. So this would probably be like a solid investment as long as the valuations aren't too bad. Now, is Hanes brands, are they going to massively explode because everyone's going to need a bunch of white t-shirts and underwears? Like, no, right? This is not a growth company. This is like more of a solid consumer staple where like this is the things the basics that you have to buy whether you're in a recession or whether you're in this great bull market and everything's going up. So it's more of like just a stable kind of buy. But anyways, consensus PE forward is 8.78, so that's good. I would like to know what their current PE is, but they think that in the future it'll be 8.8 or 8.7, which is fine. And then their price to book right here listed right there on the front page. So that's kind of nice. Price to book, 2.7. Oh, let me zoom in here for a little bit for you guys. So price to book is 2.77. I'm actually happy with that. I think that's good. That's like fairly priced. They have a low PE. And then if you want to see what their current PE is, instead of the forward, there's a little valuation tab right here. Click on that, and then it lets you the same stuff. So it shows you that the price to book come all the way across to the current tab is 2.7. So we like the current price to book, and the current price to earnings is 5.8. So their current PE is actually better than their what people think their PE will be, in a couple months or a quarter from now. So Hanes Brands, I haven't bought this yet. I do plan on buying some Hanes Brands because I think this on a value basis is good, and being essentially a consumer staple where people aren't going to stop buying their white t-shirts and underwear, I think this will be fine even if we enter a recession or a depression. Now let's pick another stock. So go back to Market Watch. Let's find Adobe, right? Now, do we think Adobe is going to take over the world? No, I don't. I mean, they have a stable line of products, right? They're like, Acrobat Reader and some other software stuff. But they're no crazy growth story here, right? It's not an Amazon. So the reason I bring that up is look at their PE ratio. They have a PE ratio of 48, right? If you remember from my other video, PE ratio over 20 is kind of bubble territory overvalued. At 48, I'm not buying that myself. And we talked about how maybe some companies, it makes a little more sense to buy a high PE ratio if you think they're going to have massive growth. So if you think Amazon's going to take over the world, which maybe they will, well then maybe you can afford to pay a higher PE ratio because their earnings, if the company grows, their earnings explode. But I don't really think Adobe's earnings are going to explode. So I think the earnings per share might grow slowly, but it's not going to go anywhere crazy. So I would not be willing to pay $318 for something that's only making $6 and therefore a PE ratio of 48. Now, well, what do they look kind of price to book value, right? So look, their price to book ratio is 14.8. That is absurd. I said, remember, less than 1 is in a crazy good deal, like what's going on. Less than 3 is fair. 3 to 5 is a gray area, which I'm like, it's okay, but nothing crazy. And then over 5 is overvalued. Well, here I am paying 14 times what the net worth of the company is, and I'm paying 53 times what their earnings are. So for me personally, Adobe is not anywhere on my list of things to buy. That doesn't make any sense for me right now. Now, if Adobe gets way cheaper, maybe there's a different story, but not at current prices. All right, guys. So that's it for today. I appreciate you guys watching the video. I'll try to make more of these. I'll try to pick up the pace a little bit. I know it's been a little bit since I've made my price to earnings video. Let me know what other metrics you'd be interested in. I'll try to go over more. If you like the video, we highly appreciate it if you guys come down here and hit that like and share button, share it with your friends. Comment below. I'll be happy to respond to all of our listeners, all of our watchers. And thanks so much, and I'll try to see you guys in a week. All right, bye.